Hey everyone, thanks so much for joining. We're going to give everybody about 2 minutes to come in. We have a bunch of folks in the waiting room. We just opened, so I'm sure there'll be more. So please settle in. We're going to get started in 2 minutes. If you are just joining us, I would love to hear from you in the chat, where you are zooming in from and what type of business you have. And I'm just going to keep repeating myself because there are people just flowing right on in. So again, you're in the right place if you're here for Collective's webinar, How to Lower Your Estimated Taxes. And we are going to get started in about 2 minutes. In the meantime, I would love to hear from those of you who are already here, where you are zooming in from, so where you're located, and what type of business you have. So we already got our first one in the chat from Janet. Arizona, working in tax prep. This should be an interesting webinar for you, and I feel like you'll know most of this content. Asia is from Brooklyn, New York, and you have an educational consulting business. Very cool. Becca from SFA area. That's where I'm located. I'm in Oakland, personal training business. Alexis from Long Beach, California, HR consultant. Rocco from Minnesota. Vanessa, oh my gosh, you all are like going for it. I love it. From Washington, D.C., a single member LLC and a sole prop. Rachel from Boise, Idaho, in construction. Naneka from Murrieta, California, trying to open a business. Well, welcome to self-employed life. Ashley from Hoboken, New Jersey, event planner. Hello. Melissa from Maine, leadership coaching and consulting. Gabrielle is zooming in from Austin, Texas, freelance copywriter. It's moving so fast. Michigan. Oh my gosh. Now it's really going off, guys. Akea from Michigan, women's apparel and accessories boutique. Gurnett from Loma Linda, California. Thrive Wellness Institute, naturopathic doctor. Very cool. John from Brooklyn, New York is an artist, co-signing artwork to galleries to sell. That's amazing. Brooke is from Denver, Colorado, a wedding planner. Charlie from Alaska, conservation wildlife photographer. Oh man, I'd love to see your photos. Luis from San Jose, just starting my LLC for IT compliance services. Very, very important. Our IT department here would agree. Candace from Raleigh, North Carolina, social media manager and strategist. Elizabeth from Atlanta, public relations. Anne Tasha from DC, lifestyle goods. Veronica from Chicago, construction. Nick from Ashland, Oregon, a freelance copywriter. Sean from Florida, LLC filing as an S Corp. Am I in the right place? You are in the right place. We're going to be talking about estimated taxes. We're going to be talking more about S Corps. If you want to learn more about S Corps and you want to understand what you already have a bit more, you definitely will get some value out of this webinar. Okay, so thank you everybody for putting your information in the chat. I'm gonna go ahead and switch over to the slides and get started because we have a lot to cover and I wanna make sure that we are gonna be able to get through the content and have time for our live Q&A at the end. So welcome to How to Lower Your Estimated Taxes. My name is Andi Smiles. I am the Director of Customer and Product Marketing here at Collective. Just wanna give you a quick overview about what we're going to cover today. We're going to start with self-employed taxes 101, how you are taxed typically when you're a self-employed person. We're going to talk more about S Corps, so you're going to get a bit of a primer about how S Corps can help make taxes less of a burden. Then we're going to talk about estimated taxes. So we're going to talk about what they are, what you need to know, how to estimate them. We'll tie that all back to the differences between being a sole proprietor and an S Corp when it comes to estimated taxes. And then we'll share a little bit more about Collective and have a live Q&A at the end. For the live Q&A, please put your questions in the Q&A box and not in the chat. The chat can get very noisy in these webinars, and often it's very, very difficult for me to keep track of questions I've answered in the chat. However, in the Q&A box, I can mark off what I've answered. So you have a much better chance of having your question answered if it is in the Q&A box. That is my request to you. I also just want to send a quick note from our legal team. This webinar is for educational purposes only. Nothing contained in this or any other related webinar should be viewed as legal or tax advice. Always consider consulting a professional if you need legal or tax advice in operating your freelance business. Now, as I mentioned, this webinar is hosted by Collective, And Collective is the first all-in-one online financial platform designed for self-employed people, just like all of you. So what does this really mean? Because this is a lot of words on the screen. Well, here's your money when you're self employed. There's a lot of things to keep track of, including estimated taxes. But you don't just have to think about estimated taxes. You need to think about your regular taxes, how you're going to set up your business, compliance, your bookkeeping. What about the future, like your retirements and healthcare benefits? And when you need to make a financial decision, this stuff gets even more complicated because everything kind of connects to each other and feeds off of or into each other, and it can get really overwhelming. This is when people often feel like things are slipping through the cracks or that they're very disorganized because they realize that while everything should be talking to each other, it isn't. So at Collective, when we say we're the first all-in-one financial platform for self-employed people, what we really mean is that we're taking all of these different parts of your business finances and we're bringing them under one platform, one login, one place for you to manage all of these things. Now, we'll talk more about Collective later on. I just wanted to give you a quick overview. And now I want to hear a little bit more about you. So Sarah is going to launch a poll and I would love to hear from everyone here. What stresses you out the most when it comes to taxes? Is it setting up your LLC or S Corp, preparation and filing, so just doing the taxes, having clean books so you can do the taxes, finding skilled financial advice, or retirement and benefits planning and how that relates to taxes? So I'm going to take a sip of tea, give everyone a few moments to fill out this poll, and then we'll keep moving. All right, let's close the poll and see what the people have to say. All right, so 20% of you said setting up your LLC or S Corp. 41 said preparation and filing. I hear that. It is so stressful. We'll talk a bit about how Collective can help with that in the future. 17% said having clean books. I get it. A long time ago, I was a bookkeeper who didn't do my own books, so I understand how overwhelming and hard it can be to keep up with the bookkeeping side of owning your business. 14% said finding skilled financial advice. 9% said retirements and benefits planning. Thanks all for sharing. We're going to go over some of these things today, so hopefully you'll be a little less stressed out by the end of this webinar. So let's start with self-employed federal tax basics, because we need to understand this layer of taxation before we talk about S Corps and your estimated taxes. This will all come back around later in the webinar. We're just building the foundation right now. So when you're self-employed in the United States, there are two types of taxes that you pay, and the first tax is income tax. Now, this is generally what people think of when they hear the word taxes or April 15th or tax season. In the United States, we pay between 0 and 37% based on your tax bracket. Now, the nice thing about income tax, it is not a flat rate. So if you were to ever hear somebody say, oh, you're in the 24% tax bracket, or you're in the 22% tax bracket, you might be thinking, oh my gosh, I'm paying 24% on all the income that I earn. That's a lot. But that's not actually how the US tax system works. How our tax system works is that we have what's called a progressive tax system. That means that your income is actually going to be taxed in chunks or tiers. So the first chunk of income that you earn may be taxed at 10%, the next at 15, 18, 20, and then you cap out at your tax bracket. So if you're in the 24% tax bracket, that means the last chunk of income that you earn is taxed at 24%. So you see, you're not paying 24% on everything across the board. You're actually paying an average of all of these chunks or tiers when you think about what your actual tax rate is. So this is a good thing. We like this. It means that we're not paying as much in taxes, but it does mean that calculating income tax is a little bit trickier than just having a percentage and saying, this is my percentage and multiplying it. Now, the other tax that self-employed people pay is self-employment tax. Now, self-employment tax is different from income tax because it is a flat rate of 15.3%. And when you pay self-employment tax, you are paying into your Social Security taxes and your Medicare taxes. Now, when you are an employee and not self employed, you are also paying into Social Security and Medicare taxes. But the big difference is that when you are an employee, half of these taxes are paid by your employer and half of them are paid by you. So you are only on the hook for half of this 15.3%. But when you're self employed, you have no employer, right? You are self employed, which means that you are on the hook for the whole 15.3%. And this is why, if you come from a more traditional employee job into self employment and you're like, why are my taxes so expensive? This is like wild. The reason is because you are now footing both halves of the self employment tax bill or the Social Security and Medicare taxes. So that was a lot of percentages, but let's actually look at this in practice to really help you understand why self-employed taxes can be so expensive. So here's an example where somebody might owe $15,000 in Social Security and Medicare taxes. If they were an employee, they only are paying 7,500 of it. The other 7,500 is going to be paid by the employer. So you don't have to worry about that part at all. But when you're self-employed, you pay the whole 15,000. So you have to do the entire pie. There's no one there. There's no light purple to help you out. This is really what's going on here. And again, this is why your taxes can feel so expensive when you are self-employed. Now, I want to go through how you're taxed when you're self-employed, and then we'll talk about S Corps a bit, and then we'll come back to estimated taxes and how this all plays together. So when you are self-employed, either if you are a sole proprietorship or a single member LLC, this is going to be how you are taxed. Here at the top, you have your revenue. This is just the money you earn for selling your goods and services. I always thought of it as like pure undiluted money. It's before expenses, it's before taxes, it's just the money that you're earning. And then you have your tax deductions. These are the expenses that you incur to operate your business. When we take our revenue and subtract our tax deductions, what's left is called net income. And if that is a positive number, that's what's called profit. And if that's a negative number, that is what's called a loss. So in either case, when you are self-employed, whether you have a profit or a loss, that profit or loss is going to flow or pass through to your owner tax return. Now, this is a good thing because this means that you are going to report your profits and losses on your tax return, and your business itself is not taxed at a corporate level. We like this. And then you, the individual, via your personal tax return, will pay self-employment tax at 15.3%. That's paying into your Social Security and Medicare taxes, and income tax. Now, as I mentioned earlier, income tax is not very straightforward when it comes to trying to figure out what that might be, because your income tax is going to be your business profits plus all other income in your life. So if your business is a side hustle and you have another job, you're going to combine those incomes. Or let's say your business is your main hustle, but you're filing your tax return jointly with somebody who has other income, you're going to combine everything together. So basically, all income in your life gets combined with your business profits. And then we subtract things like your personal adjustments and the standard deduction or itemized deduction, depending on what you're taking. What's left is your personal taxable income, and that is what income tax is assessed on. So I am not showing you this because I expect you after this webinar to go calculate your own income tax, especially because most of you said preparing and filing your taxes is really stressful. That's even more stressful. I'm showing you this to just to help you all understand that income tax is not something that we can just throw blanket percentages around with and say, oh, your income tax is this, because there's a lot of nuanced factors. The other key takeaway from this slide is that you are paying both of these taxes. So you're not paying whichever one is more or less. You're not paying whichever one you feel like. I think we all know the IRS wouldn't like that. You're paying both of these combined. That is what your final tax bill is based on. So that is an overview of how you are taxed as a sole proprietor or single member LLC. Let's talk a bit about the S Corp. So, what is an S Corp? Before we can even get into what an S Corp is, we need to talk about another concept first, which is legal structures. So, legal structures are typically formed in your state with the Secretary of State. Now, you want to think about things like an LLC and a corporation. Those are both types of legal structures and probably the most common legal structures that you have heard of. And when you have a legal structure or you're going to establish or form a legal structure, you are going to go through a formal organizational process with the state. And that's usually going to happen with the Secretary of State. So that means you have to go file paperwork. That means you have to usually pay a fee. That means you're going to have to sign stuff. So if you haven't done all that work, and you're like, I don't know, I just am like self-employed and started making some money, like I don't have a legal structure. If that's you, then you are what's called a sole proprietor, and that's going to happen by default. But if you wanted to have an LLC, if you wanted to have that separate legal structure from just your personal self, it is going to require a formal organizational process. Now, keep in mind, legal structures are formed under the state. So I can't tell you exactly what that looks like in your state because every state is different, but you can expect to file certain paperwork with your state. Now, generally, when you have a legal structure, you also are going to need to file an annual report, letting the state know who manages the entity, and sometimes there's an annual fee as well. Now, again, this is different state by state. Some states have annual reports, some states have biannual reports, some states have weird ones like every 3 years. So it is state by state, but generally there's another layer of ongoing paperwork and fees that you will need to pay in order to maintain your legal structure. Okay, so you're probably here just being like, okay, but I want to know what an S Corp is. Like, why are you telling me about LLCs? The reason I'm telling you this, all of this about legal structures, is there is a very, very common misconception that an S Corp is a legal structure. An S Corp is not a legal structure. An S Corp is a tax election for your legal structure. So the IRS decides how every legal or business structure is taxed. And when you have a legal structure like an LLC or a corporation, you can ask the IRS to change the way you're taxed. So an LLC by default is taxed like a sole proprietor. That's why earlier when I showed you that chart, that taxation chart, and I said this is if you're a sole proprietor or a single member LLC, they're taxed the exact same way. But if you are an LLC, you can go to the IRS and you can say, I don't want to be taxed like a sole proprietor. I don't like this. I don't like paying all these taxes. We saw how expensive those taxes could be. You can go to the IRS and say, I want you to tax me as an S Corp. And then the IRS will change the way your LLC is taxed. Now, key takeaway here. If you are an LLC being taxed as an S Corp, you are still an LLC. I always think about it like building a house. So when you build a house, the first thing you do is you lay the foundation. That is your legal structure. That's the LLC. You've laid the foundation. Whatever you build on top of it in terms of your tax strategy, like asking to be taxed as an S Corp, that doesn't change the underlying foundational component of your business. So if you are an S Corp, your underlying legal structure is an LLC. Really, the most like technical way to describe yourself is I am an LLC taxed as an S Corp. And we saw someone earlier today in the chat say that. They said, I am an LLC and I have the S Corp tax election, right? So still it's a both and rather than an either or. And that's something that often people get confused or there's misconceptions about. So it's a very important point to keep in mind. And we're going to talk about how S Corps are taxed now and why you might want to change your tax treatment. But just remember, if you have an existing LLC or corporation and you're asking to be taxed as an S Corp, you maintain that underlying legal structure. Okay, so why would you do all this, right? It's like, okay, seems like a lot. Like now I'm like changing things around with the IRS. Like, why am I doing this? The primary benefit of the S Corp tax election is that S Corp owners don't pay self employment tax on their business profits. Remember, that's that 15.3% that's paying into your Social Security and your Medicare. Instead, what's going to happen in the S Corp tax structure is you're going to create an employee and employer relationship with yourself. It's a little meta. You have to kind of like split yourself in two here. And you are going to be required, the employer part of you, the S Corp part of you, is going to be required to pay the employee part of you a reasonable compensation through payroll. In other words, you become a W-2 employee of your own business and you earn a paycheck through your business. It has to be run through payroll. Now, only your employee wages are subject to that 15.3% tax. So before we had all of our profits subject to that, now we just have our employee wages. That's, remember, 15.3. Just remember that 15.3 is going into Social Security and Medicare. Half of these taxes will be withheld from your paycheck, and half will be considered employer taxes as the S Corp. So remember earlier I showed you that pie chart of the 15,000 and I said when you're self-employed, all of that you have to pay yourself. And when you're an employee, your employer pays half of it. Well, now you are your own employer. The business is employing you. So half of those 15.3% taxes are going to be paid by the S Corp and become a tax deductible expense. Now, your S Corp profits are still going to pass or flow through to you, just like the other tax structure I showed you. And you are also going to report your W-2 income on your personal tax return. That becomes your total income. And you're going to pay income tax on both because we cannot make income tax go away. So this is a lot of like verbal explanation. I want to walk you through this a couple different ways to help you really understand how things are taxed. Because I know there's a lot of different learning styles and sometimes just hearing it like this doesn't make any sense. So this is just a quick reminder. We're not going to go back over this. It's just to refresh our brains of this is how you're taxed by default if you're a sole proprietor or a single member LLC without the S Corp tax election. Now let's look at how you're taxed as an S Corp. So we have our revenue at the top. Remember, pure undiluted money, money that's coming in from selling your goods and services. Then we have your business expenses, right? The same things you had before. You still need to operate your business. And now we have your salary. Your owner's salary becomes a business expense. It's a tax deductible expense of the business. And we have those payroll taxes. That's 15.3%. It's paying into your Social Security and your Medicare. Now we're going to take our S Corp revenue. We're going to subtract the expenses. We're going to subtract our salary. We're going to subtract half of the payroll taxes. What is left is your S Corp profit or loss. And that profit or loss is going to pass and flow through to your owner tax return. Now I'm going to stop here. Remind us that we like this because this means that your business still isn't being taxed at the corporate level. This means you're going to avoid the double taxation that happens with C Corps. So this still is going to pass to your personal tax return, and you're going to report those profits plus your W-2 income, your salary on your personal income tax return, and that is what you pay income tax on. So you might be looking at this, and you're like, I get it. How am I saving money? Like, what's going on here? How am I actually going to save any money with this thing? So let's walk through that. And this will also reinforce some of the concepts we've just introduced. So let's say you are a single member LLC filing without the S Corp tax election, and then you have the S Corp tax election. And let's say you make $160,000 in profit. Now, when you are the S Corp, you're going to pay yourself that owner wage, right? So that owner wage in this example, let's say it's $60,000. Now let's look at the amount of money that is subject to that 15.3%, those Social Security and Medicare taxes. When you are the sole proprietor, it is $160,000 because it's all the business profits. When you are the S Corp, it is only your wages, $60,000. So in this example, there's $100,000 less that is subject to 15.3% taxes. This just becomes now a simple mathematical exercise. If you are to take, if you have more money subject to taxes, you pay more money in taxes. If you have less money subject in taxes, you pay less money in taxes. In this example, the tax savings is about $15,000. Now, I want to talk about the last two lines to kind of reinforce the tax structure of the S Corp. So let's look at pass-through profit. When you're a sole proprietor or single member LLC, it's just all flowing down to you. There's this just kind of like whoop, right onto your tax return. When you're an S Corp, why is it $100,000? Why is it not 160? Because your owner wage is a tax deductible expense. It's going to lower the profit of the business. So that's 100. But then why is your taxable personal income back up to 160? Because that owner wage is still getting reported as income on your tax return. So the TLDR here is that you are saving in taxes, but you are earning about the same amount in your personal taxable income. Okay, so most people at this point are like, this is cool, but like, how much do I pay myself? Do I have to pay myself? How do I know what to pay myself? So I want to touch on this a little bit. Then we're going to talk about who this structure might be right for, and then we're going to go into estimated taxes a bit more. So unfortunately, there is no set standard for reasonable compensation. This is what it's called when you pay yourself as an owner of an S Corp. It is what the IRS says is a facts and circumstances argument. So you really want to rely on a tax professional to help you here. And Collective or another tax professional should be able to help you. And the reason I say this, and the reason I say you want to look at a tax professional, is because you need to think about your owner's salary as a tax strategy. You are trying to strike the balance between tax savings and being within the rules of the IRS. So for example, I love this little image that we have here because it really helps showcase what we mean by this. This is a little slider. Now let's pretend we were to slide this all the way up and pay ourselves all of our profit. Now, in this case, we would have zero tax savings because we're just replicating the tax structure of a sole proprietorship. But you would have great defensibility with the IRS because they're getting more taxes. Now, let's say we took the slider and we slid it all the way down to zero. In this case, your tax savings would be going through the roof because you would be paying nothing into Social Security and Medicare taxes, but you would have zero defensibility with the IRS. So when we say you want to strike a balance, it's that you want to get the tax savings because this tax structure is available to you from the IRS, right? Like this is something that they are willing to give you. So it isn't about not utilizing it, but you need to utilize it in a way that is still within the rules of the IRS. And that's what they mean when they say reasonable compensation. It needs to be reasonable. If your business has $300,000 in profit and you're paying yourself $100 a month, that is not reasonable, right? On the flip side, if your business has $40,000 in profit and you're paying yourself $39,000 a month, that's also not reasonable. No business is going to pay out everything into payroll, right? So it's finding that reasonable piece that's really key here. Okay, so you're probably wondering, should I do this? Should I not do this? Like, how do I know this is right for me? So let's talk about this. An LLC or a sole proprietorship, so just staying as a sole proprietor, is best for those who are, first of all, new to business with very little earnings. If you're just getting started and you either haven't made any profit yet, which means maybe you have income, but you have a lot of startup expenses and you're carrying a loss, you really don't, it's not really the time for the S Corp tax election. Here at Collective, we use $60,000 in profit per year as the threshold that we recommend. Now, this is not an IRS guideline. The IRS lets you do whatever you want. This is from our own work as S Corp experts and working with thousands upon thousands upon thousands of solopreneurs. We have found that at $60,000 in profit, this is self-employed profit per year, is when you really begin to feel the S Corp tax savings. Because the other thing about S Corps is they're more complicated, right? There's more things that you'll need to do to maintain and manage your S Corp. So you want to ensure that you have enough tax savings to either offset the cost or the time that that complexity is going to cost you. This is also best, like S corp is, it makes sense for people who want a simple straightforward tax structure, because now you have payroll. Now you have another S corps have to file a secondary tax return. Now you have to think about things like, what's my reasonable compensation? There's more complexity. So if you're watching this and you're like, I don't want to think about any of this, I honestly do not care, I just don't want to think about it, an S corp does require a little bit more thought. So, an S Corp tax election is great for folks who want to first maximize their retirement savings. Now, I know there was some folks in the poll who are interested in retirement. Um, when you have an S Corp, you are allowed to contribute to what's called a solo 401k. And what's cool about this is, because you have now established this employer employee relationship with yourself, you can contribute to the same account as both. So you, the personal you, can still contribute like personal contributions, but your S Corp can match or more than match your contributions and also contribute into that same account. The S Corp's contributions actually become a tax deductible expense of the business. And also, they have different contribution limits. So often, when you combine the contribution limits of like the personal contributions versus the employer contributions together, they can be higher than other retirement accounts. So this is sort of like the unsung hero of the S Corp tax election. I hear this a lot from people, that one of the things they've really loved about it is being able to maximize their retirement savings. Now, it's also good for people, we've already talked about this, earning more than $60,000 in self-employment profit per year. We've discussed this. And finally, it's good for people who have the cash flow to make regular payroll runs. What I mean by regular is I mean consistent. What you don't want to happen is for you to go through the whole year, not run any payroll because you don't have the cash flow to do it, and get to November and realize in order to be compliant, you need to do a $60,000 or $70,000 payroll run. That most people don't have the cash on hand for that. So you do need to ensure that you have healthy cash flow where you can really make those payroll runs so you can stay in compliant and really just not like hurt yourself at the end of the year. So that's a bit about S Corps. Now, I want to talk about estimated taxes, and I promise we're going to bring all these concepts back together at the end of how S Corps and how S Corps can help you with estimated taxes, besides just lowering the tax burden, right? Because I think up front, what you can really see is like, you want to lower how much you're going to pay in your estimated taxes. Well, you need to lower your overall tax burden. But there's a couple other things that come into play as well. But before we get into all that, I want to just start with like the basics of estimated taxes. So the first question you might have is, who pays estimated taxes, right? Do I have to pay them? What if I'm brand new? What if I have a loss in my business? The rule is, if you think you would owe $1,000 or more in taxes at the end of the year, so this is for your total annual tax bill, then you are required to pay estimated taxes. So if you are, and this, when we say taxes, we're talking about the combination of self-employment tax and income tax. So remember way back when we went through how you were taxed, we're really talking about that. It's the combined bill. So first, it's like, how much money am I making in my business? And do I think I'm going to owe more than $1,000? Now, if you're a brand new business owner, you're running a loss, and you know you're going to have a loss at the end of the tax year because you just have so many startup expenses, or you just haven't caught your revenue up to your expenses, then you wouldn't need to pay estimated taxes because there's nothing to tax you on. But if you have, healthy profit, then more than likely you are going to be required to pay estimated taxes. If you think you're going to owe more than $1,000 in taxes on your self-employment income, you need to pay estimated taxes. This includes independent contractors, people who have their own businesses, people who file as sole proprietors, and LLC owners, regardless if you have an S Corp tax election or not. So if you own a whole LLC, like you're a single member LLC, or you own a part of an LLC, which means that you are a part owner of a multi-member LLC, you still are on the hook for paying estimated taxes. Again, if you think you will owe more than $1,000 at the end of the tax year. Okay, so let's talk a little bit more about like the basics of estimated taxes. So, first of all, why do these things exist? Well, the taxes need to be paid as you earn or receive income throughout the year. Now, when you are an employee, this is happening through paycheck withholdings. So every time as an employee, when you get paid, the government is taking a little bit out of that payment to pay into your taxes as you earn the income. What's challenging for self-employed people is if you don't have the S Corp tax election, you're not making those, you're not getting those withholdings, which is means that you have to do that through a different mechanism, which is the estimated tax payments. So really what this is all boiling down to is that the IRS wants you to pay your taxes as you earn or receive income throughout the year because you don't have a paycheck, you're doing it through estimated taxes. We already talked about this, but I just want to reiterate, you must make estimated tax payments if you expect to owe $1,000 or more at the end of the year. Okay, so if you don't pay enough taxes throughout the year, you might be charged a penalty, right? So if you are missing payments or you haven't made any payments at all or you're underpaying them, you could have a penalty. And we have that here too. You may be charged a penalty if your tax payments are late. This piece is key. Even if you are due a refund when you file your tax return. So even if you at the end of the, let's say right before you file your tax return, you're like, I'm going to throw a bunch of money at my tax bill because I didn't pay anything at the end of the year, and you're going to get some of that back, you may still incur penalties because you paid late. We're going to get deeper into the penalty piece in the next slide. Let's talk about when they are due. They are due quarterly, except not normal quarters. They're due quarterly, but not the way we normally think about the end of a quarter. So estimated tax payments are due on April 15th, which can be confusing because your regular annual tax payment is also due. So you want to keep that in mind when you're thinking about your cash flow. Okay, I know I'm going to have to pay my regular tax bill if I haven't paid in enough on estimated taxes, plus make an estimated tax payment. They're due June 15th. That one's weird, right? June, okay. September 15th. And then the last payment is due on January 15th of the next year. So that's considered your Q4 or like last payment of the year. It happens in the following year, but it's actually for the previous tax year. This one can be kind of confusing for people too. Okay, so let's talk about underpayment penalties. Okay, so you can be subject to underpayment penalties and interest when you go to pay your annual tax bill. So if you have a really high tax liability, you haven't paid into your estimated taxes throughout the year, your tax bill could be bigger than what you're anticipating because you haven't accounted for those underpayment penalties. So even if you are due a refund, you can still be hit with these underpayment penalties for missing a tax payment because you didn't pay the tax as you earned the income. Now, I want to share with you how the IRS calculates underpayment penalties because it's not simple. So again, it's one of these things where people often are like, well, how much will my penalty be? And it's like, well, it's based on a lot of different factors. So I'm going to go over that with you. First of all, the penalty can be based on the amount of the underpayment, right? So that one's pretty straightforward. It's like you were supposed to pay 5,000, you paid 2, there's 3,000 that has been underpaid. But this is where it gets tricky. The period when the underpayment was due and unpaid. So this is where calculating this gets tricky because the period when it was due and unpaid may vary, right? Were you supposed to pay this in January and you didn't? Or were you supposed to pay this in April and you didn't? That's going to elongate the periods. And then finally, the interest rate for the underpayments that are published quarterly. So this again is where it doesn't get so straightforward because suddenly now things are changing quarterly. So we have 3 very complicated factors involved here. So it can be tough to be able to calculate your own underpayment penalty. Here's what I will say about underpayments and penalties. If you have a very high tax liability, this can sting. If you have underpaid your estimated taxes by $1,000, it's very, very minimal. So I don't want to scare people, especially if you're at this point in the year and you're like, oh my gosh, I have not paid two of my quarterly tax payments, the April and the June one. I don't want to scare you into thinking like your whole world is going to fall apart. You're going to owe all this money because based on what your liability is, it can be very minimal. Look, I've missed when I was self-employed, I missed tax payments all the time. It's what happens. And yeah, there is an additional penalty on my tax return. It's not like it's 20 grand because I didn't owe that much in taxes. But again, this is all based on the liability. Now, the other thing is just like, I think people often are like, if I miss a quarterly tax payment, am I going to jail? Is the IRS coming after me? No, they're just going to slap you with penalties and interest. So try not to spiral out if you've missed some payments. But also think about how you can get yourself on track. Okay, so let's talk about how to estimate your federal taxes. There are two ways. So there's estimated tax safe harbor rules. Basically, these are the rules that if you follow them in good faith, you've considered paid, you have been considered paid your taxes. So you want to pay the lesser. So the first way to estimate it is you're going to do 90% of the current year's taxes. So let's say that you think this year you're going to owe $1,000. Well, you're going to figure out what is 90% of what I think I'm going to owe this year. In this example, it's $900. And then you're just simply going to divide that by 4. So you're going to say, okay, 4 divided by 900 is $225. So this is one way you can calculate your estimated taxes is by thinking about what you think your current year's taxes are going to be. Now, and paying 90% of that. Now, of course, this requires you to be able to project your income. This you have to, if you are, filing without the S Corp election, you're going to have to think about self-employment tax at 15.3%, and you're going to need to know your basically effective tax rate, that average tax rate of all of those tiers. And that's how you're going to get to the amount that you would owe. So there is a little bit of math involved with this one, but the benefit is that it's based on the here and the now, which can be helpful. The second way is 100% of last year's taxes. So this one can be a bit more concrete because you know what you paid last year. So let's say you owed $2,000 in taxes last year, you're just going to divide that by 4. Right? So I owed $2,000 last year, divided by 4 is 500. Now, the pro of this is it's more concrete because you know what you paid last year, right? It's like you have a very clear idea. The con of this is that if your business makes significantly more or significantly less, specifically less, like if your business is making a lot less than you made last year, sure, you'll be due a refund, but the IRS is holding that money the whole time. So that can often be a con for people. And it really just depends on like how your business income and profit fluctuates. So these are two ways to estimate your self-employed taxes using safe harbor rules. Now, you can also base your estimated taxes on actual income and expenses. So the first thing you're going to have to do, and this, I will be honest, this method involves a lot of math. So if you're like one of those people that's like, I love math, love making myself a spreadsheet and having all these factors and like figuring it out perfectly, this is great for you. If you're like, no, thank you, I just want to divide by 4, go back to the last slide. So you need to first know what your income is minus all of your adjustments and business expenses. So that's the first piece. So this becomes more complicated if you are filing jointly with somebody, right? This becomes more complicated if you have a lot of tax deductions and personal adjustments and things like that. If it's just you, this is probably a little bit simpler. I used to do this when I was single. I did more of this method because I was like a mathy person. But once I was married, I was like, I'm not doing that. It's like way too much work. You are then going to take your taxes into account. So you're going to multiply your adjusted gross income, that taxable personal income, by your tax rates. Going back to those first slides I shared with you, right? So we're going back to all of that. Then you're just going to multiply the two. You've got your income, you've got your taxes, multiply it all together. That is your estimated tax payment for the year. And then you'll calculate your quarterly tax payment for the year by 4. So you're going to divide that. I actually used to do this every quarter if because I wanted my quarterly taxes to be that exact. So that's what I would do. I would just do this every quarter, and then every quarter kind of like make sure that I made up the difference if there was more I needed to pay. That is a very extreme way of doing this. I only recommend doing that if you are, again, very into like the mathy side of all this. If not, remember you have the safe harbor rules at your disposal. You can use the divide by 4 last year's payments, right? You have that at your disposal. It's just really how deep into it you want to get. Now, the last thing I want to say about this before we talk about how the S Corp helps with the estimated taxes is they aren't just for the federal government. States have them too. We don't go over this in the webinar because every state is different, but you also need to consider that it isn't just federal estimated taxes you're required to pay. States are also require you to pay some, well, if your state has income tax, some level of quarterly tax as well. So keep that in mind. So let's talk a little bit about estimated taxes as a sole proprietor versus an S Corp. So sole proprietor, the big drawback here, which I think we've talked about quite a bit, is you have 0 withholdings through a W-2, right? So we talked about this, about you have to pay into your taxes as you earn the income. When you're a sole proprietor, the only mechanism you have for that is via the estimated tax payment. And the other tough thing is that you have to estimate the amount of income that you earn, that you expect to earn, and pay the estimates on that entire amount. That can be really hard when you're self-employed because our businesses fluctuate, right? Income in our businesses fluctuate. And the other thing that's tough about it is like businesses can take off. Like I've had that happen. I've had clients who've had that happen where your business just kind of skyrockets. And now that's a whole thing that you didn't expect and you're re-estimating your income. So doing this as a sole proprietor, it's not that it's impossible. Again, we have those safe harbor rules to make it a little easier on you, but there are some challenges. Now, with the S Corp, there are a few ways that this gets a little bit easier. First, you pay yourself as an employee and have withholdings through your W-2. So all of the income that you earn via the salary is automatically going to have those withholdings through your W-2, which is really nice because that's happening in real time. So you're not really having to worry about the salary portion of your income because it's all happening through your paycheck. Now, this is one of my favorite things about the S Corp, something I did, something I used to advise my clients to do. You can increase your W-2 withholdings to account for other income earned throughout the year. Because when you're an S Corp, you still have to pay estimated taxes on the expected profit. But if you can expect that, okay, I think my profit's going to be $100,000, then we go back and we do a little bit of mathy math, and maybe it's not perfect, but you can actually say in your W-2, I want additional withholdings to cover that. So then you are paying into that in a way that might be more sustainable for your cash flow because it's automatically coming out of your W-2. If you don't want to do that because you're like, it's not really like, I'm not into that, you only then have to estimate your estimated taxes due on the income above your salary. So again, it's like what you expect the profit to be. So there's still a little bit of mathematical element, but I like the idea of being able to add additional W-2 withholdings to your S Corp paycheck and really just kind of like automatically pay into your estimated taxes. And it's happening on a monthly or biweekly schedule versus every quarter, which feels like a bigger chunk of money coming out. And I think that's a way that the S Corp can really help folks with the estimated taxes. Okay, so starting an S Corp can help you lower your taxes later. That's the thing I want us to all think about because we know that there's a tax savings aspect to the S Corp. We went over that, but there's also ways that it just makes the process of paying a lot easier and can help you avoid those penalties and interests. Now, I want to chat a little bit about how Collective can help you with your S Corp. Now, this is what it's like on your own without collective. It looks a little bit different than the one I showed you earlier because this one is specifically for S Corps, right? We have S Corp set up. We have those estimated tax calculations and reminders, right? We have to calculate that reasonable compensation now. We have more taxes to deal with, right? So there's a lot more going on. And this is your S Corp finances with collective. Everything is under one roof, everything is in one place. And specifically for the purposes of this webinar, one of the things that we do is we do send you estimated tax calculations and reminders. We're going to talk more about that in a minute. So collective works with sole proprietors, LLCs filing as an S Corp, single member LLCs, and self-employed people who have profits of $60,000 or more, as well as some mental health providers. So we work with a lot of different people. And I know there's some folks here who said they were a sole proprietor. We have some folks here who said they were single member LLCs. We had someone here who said they were an LLC filing as an S Corp. We can support all of you, but we do work exclusively with folks who are earning $60,000 or more in profit. The reason for this is that we specialize in S Corp. So we are the S Corp people. We specialize in the S Corp tax selection. And even more importantly, I think, than just specializing in S Corps, we specialize in S Corps for solopreneurs. So let's be real. When you are self-employed, if you're a solopreneur, maybe you have a couple contractors, but really it's you. What you need is very different than a business with 20 employees. It's just a completely different type of financial back-end support that you're going to need. And that is really what we specialize in. So I'm going to go over a bit of what Collective can do for you. I always think about it as one login to run your business because a reminder, we are that all-in-one financial platform. So we do LLC formation and S Corp tax election. So if you are sole proprietor and you don't have your LLC, we will form that in the state for you. We will also file your S Corp election. So if you are already an LLC, but you're like, I want to make some money, I want to save some money on my taxes, we will file that S election. And we'll also do some of those pieces that a lot of other businesses charge you for. It's all included, like getting your EIN, setting up your operating agreement, a lot of the best practices for really getting your business established and organized correctly. Then we have ongoing bookkeeping and accounting. So every collective member receives monthly bookkeeping. We have a team of human bookkeepers. I always say human because a lot of people have been asking me like, oh, does AI just do everything? No, we have human bookkeepers who do your monthly books. We also take care of some S Corp specific accounting. We didn't have a chance to get into a lot of that today because we were focusing on estimated taxes, but there are these pieces like the accountable plan, which basically reimburses you for personal expenses, and some other things that are nuanced to the S Corp that our bookkeeping team will take care of. And then we have this really cool platform where you can go in, we call it collective accounting. You can run your monthly financial statements. You can see, you know, what's going on in your books. You can see all your transactions, all of that great stuff, but you do have access to those main reports that every business owner should really be looking at on a regular basis. We also do the payroll side. So through Collective, you can run your payroll. Remember, if you're an S Corp, you are an employee of your business. You need to be paid via payroll. So if you're not using a tool like Collective, you will need to purchase payroll software. We take that step out. You can run payroll directly from your dashboard. You can pay your contractors. You can file your 1099s for your contractors. We take all care of all the payroll tax filings and withholdings and sending money to the right places. And we also provide S Corp reasonable compensation guidance, which we talked about earlier. Next, let's talk about taxes, because that's what we did a lot. We talked about taxes a lot today. So S Corps do have to file a business tax return, and that is something that we enable you to do. We do that for you. So we'll file your annual tax return for your business. We'll do that both federally and state. And then here's the thing that probably after all this talk and all this math with estimated taxes might make you happy. We send our members estimated tax calculations every quarter with reminders to pay. So it's like, hey, this is what you need to pay. And here's your reminder of when to do that and what's, you're in the state, here are a link to the instructions, so on and so forth. And then we have the compliance and support side. So we do have annual compliance reminders for maintaining your LLC. So remember earlier, I said that your business will have to file certain paperwork throughout, like on an ongoing basis, pay fees. We remind you about when you need to do that. And you also have a support team, again, of human beings, of real people that you can message anytime. Now, I do want to share something that's pretty cool. If you are an existing LLC and you've been like, oh man, it's already like August and I kind of missed the boat on like being an S Corp, you did not. So, one thing Collective can do is if you are already an LLC, we can backdate your S Corp tax election to July 1st. So, this is only available for existing LLCs. But if you are an LLC and you've been kind of bumming out because you're like, oh, it's August, can I really do this? You can do it. We'll backdate to July 1st. And if you aren't an LLC and you're a sole proprietor and you're like, oh, well, I guess I have to wait, you really don't. There's still a quarter, more than a quarter left in the year. There's 4 months left in the year. You can still garner some pretty serious tax savings from your S Corp. I would encourage you, if you're thinking it's too late in the year, to really reconsider that and think like, what you may not get a full year of tax savings, but you'll still get a partial year of tax savings. So, that could look like still several $1,000s. So collective cost $349 a month. We do have an annual plan that will save you a little bit of money. And we have a one-time onboarding fee of $199. This includes everything. There's no additional fees except for any sort of state pass-through fees for forming your LLC. This includes monthly bookkeeping. This includes the payroll tools. This includes the annual tax preparation. And collective is tax deductible. Now, I'm going to invite all of you to schedule a free call with a tax advisor. Sarah is going to share the link in the chat. It looks like this code is outdated, but she shared the newer one, which is in the chat, and as well as the link to schedule a call. This is a free call. It's 25 minutes. You'll be able to talk with somebody from our team and really figure out like if this is the right step for you, if collective makes sense for you. It is a great opportunity to talk to a person about your unique situation. I'm going to go through the Q&A, but sometimes people ask like really, really like specific questions about their business that I just can't answer in a webinar. So I do encourage you, if you're like, wow, I really need to think about this, or I want to talk to somebody, or I just need to like talk this through. I need to have like a little bit more of like a conversation about this, to take us up on this free call. It's 25 minutes, super high value. Somebody just left a review on Trustpilot about how great their call was with our salesperson. Like, it's a great opportunity because our folks do know a lot about taxes. Some of them used to work at the IRS, so they're going to really be able to think about you from like your business perspective. Okay. I'm going to go to the Q&A. Okay, so I'm going to go up to the Q&A and just start answering questions. So Anonymous said, will we get a recording of this session? I imagine there'll be a lot of Q&As with this question. Yes, you are going to get a recording of this session. You will not get the slide deck, but you will get the recording, which you can watch as many times as you want. Rocco says, doing an S Corp as a real estate consultant. Great. Laura, what about those of us in states without income tax? Now, I think that what you are asking is how, I don't know if you're asking about estimated taxes or not, but if you're in a state without income tax, then you're not going to need to pay estimated taxes in that state. But you still have federal taxes. So like and this is why we focus on federal taxes here in this webinar, because, trying to keep up with 50 states plus Washington, D.C. from like a tax perspective is too much. So you still are on the hook for the self-employment tax and your federal income tax. So basically most of this is still going to apply to you. The only piece that doesn't apply is going to, actually leave this one up, is going to be like having to worry about like the state taxes. Let's see, which is better, LLC or S Corp as a small business owner? I think we've covered that, but What I will say is that it's not which one is better, it's which one is right for your business. Because and remember, an S Corp is still an LLC. It's just a tax election for your LLC. So really the question is not, should I be an LLC or S Corp? Because you will still be an LLC with the S Corp tax election. It's, does this tax election make sense for my LLC right now? I want to reframe that question because often people are like, which one's better? It's like, well, you're both. It's just which tax treatment makes sense for your business at this time. As a contractor, am I a sole proprietor if I don't have an LLC? Should I get an LLC? So yes, if you don't have an LLC and you don't have a corporation, you've just not formally organized, you are a sole proprietor. And whether or not you get an LLC is really going to be up to you deciding what your business needs are right now. The benefit of an LLC, of course, is that there's liability protection. So I often tell folks, like, how risky is your business? That will help you decide, do you want an LLC now or later? If your business is very, very risky, like for example, you're making stuff that people are ingesting, you're making something that people are putting on their bodies, there might be more risk there, and you might want that liability protection earlier. Or you also want to consider what types of contracts you're trying to get. A lot of larger companies, like big corporate names, will tend to want to contract with an LLC, not a sole proprietor. So there are things to consider about your business that have more to do with if you should get an LLC or stay a sole proprietor. And of course, then the tax flexibility side of it. If you are looking at this, say you're a sole proprietor and you're like, I want to be an S Corp, like I'm making enough money, this will save me a tons of money. You need to have the underlying legal structure. You can't just go from being an S Corp. You can't just go from, a sole proprietor cannot ask to be taxed as an S Corp. You have to have an LLC or underlying corporation. Remember, we have to lay that foundation before we can put the S Corp house on top. So there's a lot of things to consider. It's not just you should do this if this. You really need to think about like what type of business you have, what you are going to be doing in the future, what your tax situation is right now. Anonymous, what is your best advice for someone who has multiple jobs where they are a W-2 employee and a 1099 contractor with an LLC? So Anonymous, the thing about this one is that I don't quite know what you're asking in terms of like best advice. So I'm just going to kind of answer what I think you're asking. So with this one thing you want to keep in mind is like how high your W-2 earnings are. Because in some cases, when you have really high earning W-2 jobs, they offset any of the savings that you would get from the S Corp because of the Social Security wage cap. So basically, there's something called the Social Security wage cap that after a certain amount of earnings, you aren't going to be subject to Social Security tax anymore. And Social Security tax is what makes up most, let's see if I can get back to my slide, is what is going to make up most of self-employment tax. It's 12.44%. And this is really where you're saving with the S Corp. So if you have W-2 jobs and you're earning $200,000 from that combined W-2 income, then the S Corp may not have any tax benefit for you. It may be something that you've already capped out on the Social Security tax side of things. And so it wouldn't benefit you. So it's kind of hard to, again, to give you like an answer of like, this is what you should do, because there's too many individualized factors. But I would encourage you to schedule a call with one of our tax advisors. All right, Philip, as an LLC, isn't there a cap on the money that you can be paid on the Social Security part of the Self-Employment Act? Yes, and we just talked about that. So it's not actually as an LLC, it's as anybody with earned income. So this is not specific to an LLC. This is specific to anyone who makes money. So even if you're a W-2 employee, that Social Security wage cap still exists. And I think this year it's somewhere around 165 or 168. And that's actually why one of the examples that we give is 160, because this amount does not hit the Social Security wage cap. After you hit that Social Security wage cap, so after, let's just say it's 165, after you hit 165 in earnings, then you're only paying into Medicare taxes. So you still have to pay something, and you still have income tax, right? Where taxes don't just go away, but Social Security, which is 12.4% of that 15.3%, like the biggest chunk, that is going to be that you won't pay that. And this is per tax year too. So just keep in mind that the following tax year, it resets itself. Bridget, what is the difference from a B or C compared to an S Corp? Okay, so a B Corp is not a tax election at all. A B Corp is like a beneficial corporation, and it's basically kind of like a certification that you get to say that your business hits certain types of like uh pillars. They consider them pillars. So, and they grade you on each pillar, and so you basically have to be graded at a certain point of like how you treat your employees, your manufacturing processes, how environmentally friendly your stuff is, things like that. So a B Corp is not a tax election. There are some states that like accommodate it in some sort of way, but it's not like an S Corp. A C Corp is a tax election. So a C Corp is another type of tax election that you could also elect your LLC to be taxed as a C Corp, or more commonly, people who form corporations default to the C Corp tax structure. Sarah, can you put the S Corp versus C Corp article or YouTube video in the chat? Because we do have content that goes over very specifically the differences between these two. But that's kind of like a high level. So a C Corp is also a tax election. A B Corp is not a tax election. Lauren, does Collective have a one-time consultations for individuals who want specific help? We don't. We don't do that. So we're not like you can't hire us for like an hour to just answer your questions, but you can certainly chat with one of our tax advisors to see if, you know, the things that you need support with in your business, we can help with. Asia, if I ask to be taxed as an S Corp now, will this make my taxes for 2025 difficult? So yes and no. So when you do what's called a mid-year election, you will have to file taxes in a different way. So I'm just going to use the August 1st for the sake of all of our sanity. Let's say you elect to be taxed as an S Corp on August 1st. From August 1st through the end of the year, you're going to file the S Corp tax return for those earnings. Everything prior to August 1st, you are still going to have to file your taxes as a sole proprietorship because you weren't an S Corp. You weren't taxed as an S Corp in that period of time. So you will have to still have the Schedule C on your 1040, and you will need to know the difference between the S Corp income and the Schedule C income. Now, if you were to work with Collective, we obviously deal with this like all the time. And so we do have we handle the business tax return and all the bookkeeping up to the S Corp tax election date. So that part is pretty simple. And then you just are knowing like, okay, at this point in time, this is the income I've earned, the expenses, and then everything after that is S Corp. So is it more complicated than a full year election? Yes. Is it something that should be a major deterrent? I would say no. We have an article, Sarah. Can you post the article on we have a mid-year election, like how to file your taxes if you make a mid-year election article. We have something that goes a bit more in depth. So there is an additional layer of complexity. A lot of people do this. This happens all the time, right? Like we have people joining Collective every day. So I wouldn't say that it's so difficult that, especially if you're going to be saving like $6,000 in this last half of the year, I wouldn't say that it is so difficult that you should be avoiding it. For Gencio, can't you do a solo 401k with an SMLLC as well? You can. People just tend to do them with S Corps. So you certainly can. What people like about the S Corp side is that those the employer contributions become tax deductible to the business. Brenda, after making 60K in profit revenue, tax savings will offset. Sorry, I missed this statement. Sure, I'll repeat because a lot of people have questions about why it's a 60K. So when you have an S Corp, there's more complexity, right? We've talked about this. You have a business tax return you're going to need to do. You have payroll you're going to need to take care of. You really are going to have to formalize your bookkeeping more. You can't just do like a shoebox full of receipts. Even a spreadsheet's going to be very difficult because you're going to need to understand like what's employer taxes paid versus salary paid, so on and so forth. So there's going to be additional cost that goes into maintaining your S Corp. So what we have found is that there's a cost associated with the S Corp, and it's either your time or your money. For most people, it's their money. They're like, I'm not a tax expert. I'm not doing this stuff myself. So what we have found is that up until the 60K marker, you may have some tax savings, but are the tax savings really enough to offset all the additional complexity and costs that you're taking on to have this type of tax election? Generally speaking, it's not. After 60K, you will start to feel the tax savings, and it's not just like, oh, I've spent all my tax savings money on like filing my business tax return, because those are expensive. So that's what I mean by that. That's what it will offset. It's really like what I always think about it is like the tipping point where it's really worth the complexity. And again, this is our own guideline. This is not what the IRS will let you set up an S Corp with like zero money. Like they don't care. But we're coming from this as a point of view of like, when is this really beneficial to people? When does this make sense to people? When is this adding complexity, but it's the right decision to add complexity? Brenda, as for business structure, I have two different businesses, dog grooming and construction. Can they be under one LLC or two LLCs under the S Corp umbrella? They'll have to be two LLCs because they're very different in the type of business that they are. So generally, when we're thinking about can a business be under one or two LLCs, we're looking at the business activity code and if the activities are under the same code. So you could be like a marketing consultant. So maybe you build websites as your primary business activity, but you consult with people on how to improve their website. That kind of all falls into the same activity code. Dog grooming and construction, very different. So they would have to be two LLCs, and you would have them be separate. You could look at something like a holding company. Sarah, maybe we can put the holding company article, which is basically an entity that owns your two other entities, but they still are separate entities. They're still going to be two separate entities. A holding company is pretty complex. It might not really work for you, but it's certainly something that would be an option. And Sarah will put we have an article on holding companies, so it's helpful if you're really trying to figure this out and just understand your options. That article has a lot of kind of like pros and cons. Anonymous, but how do you know what your taxes owed amount will be? Multiply every paycheck by 15.3%. Yeah, it's that. Well, paycheck, not paycheck. You're multiplying. I think this is about how you estimate your taxes. You're not multiplying your paycheck, because your paycheck, that's all kind of getting taken out through withholdings. That's the benefit, is that the paycheck is doing its thing on its own through all the mathy math of the payroll platform, frankly. But if you're asking about like every month or every quarter or whatnot, if you are not an S Corp, you want to think about what was my profit this month and what is my self-employment tax liability. That's 15.3%. And then you also need to think about your income tax, right? So let's say your effective tax rate is, I'm just going to say 15% for the sake of easy math, right? So then if your effective income tax rate is 15%, remember that's the average of all the chunks that we talked about, then you're multiplying your profit by every month by 30.3%. So that's, but it's not paycheck. The paycheck is happening automatically through the payroll software. It's everything else. Will I get a recording of this webinar? You will within 24 hours. Helene, for safe harbor laws, can you change methods mid-year, i.e. Q1 and Q2? I'm filing based off of 100-year last year, and then Q3 and Q4 switch to the 90% estimate. That's a really good question, Helene, and I don't know the answer to, oops, that's the wrong slide. I'm just going back to the slide. Okay, I can't find this. Okay, here we go. Okay, here we go. Helene, that's a good question, or Helen. I don't know the answer if you can switch or not. It says pay the lesser. So, but I generally speaking, I would say that you would want to stick with one. I'm not quite sure, but from the past things with IRA, they don't like a lot of switching around. But that's a good question. We'd have to look into that. Asia, if you didn't pay quarterly taxes April or June, is it best to pay a big chunk in September? Yeah, you can catch up anytime throughout the year. And remember, what are the penalties and interests based on? Well, part of what they're based on is, man, our slides are not numbered very well. Part of what they're based on is the period when the underpayment was due and underpaid. So if you are catching up in September, you are going to shorten that period versus waiting till the end of the year. So you can certainly pay a bigger chunk or make up your payments earlier, and that will help you with the penalties and the interest. Regencio, can you show the safe harbor rules and estimated taxes again? Sure, we are here in the slides, so let me find them. I'll leave that up for a little bit because I know it's a lot of stuff on the screen and people might want to be like taking photos and stuff. Brigitte, if a person opens an LLC and registers a sole business, but the business is not up and running and nothing has been used, does the person still have to pay for the unused LLC? So I think what you're asking is like, if you have an LLC, but you haven't actually like had any business activity, do you still have to pay the annual cost of maintaining it? Yes. Well, it's state by state, so you have to check with your state, but generally speaking, yes, you still are maintaining the LLC. So like in California, for example, if you have an LLC and it's like an active LLC, even if you're not running business through it, it's just not a like you haven't wound it down or like dissolved it. Dissolve is the word. Like, you even dissolved your LLC, you still have to pay $800 every year. So it is state by state. So you want to double check with your state. Maybe your state has some kind of like inactive fee or some kind of like fee difference for something that is not like there's no business activity actually happening. But generally speaking, you still need to pay the fee to keep that LLC active. Brigitte, can an LLC be a founder mission or a foundation mission with an S Corp? So when you say foundation mission, I don't know if you're talking about being like a 501c3 nonprofit or not. Like, I'm not quite sure what you mean by this. I would say, though, specifically with the S Corp tax elections, there's quite a bit of like who can own an S Corp nuance. Sarah, maybe we have an article on this. We can put that one in the chat. So with this one in particular, I don't founder mission, I need a little bit more context. But with the S Corp tax election, there are some nuances of who can own it. I don't go into them in this webinar because it's stuff like you can't have more than 100 shareholders. Like, it's things that don't really like apply to this particular audience, but there are some things around like specific types of like trusts and estates. And there's some nuances there. So I would encourage you to read that article, especially because I don't have enough context to answer this question. I would encourage you to read that article and probably do some research into into this, because there are some nuances with the S Corp tax election. It isn't just like anyone can do this, especially when you get into like trusts and estates and things like that, and potentially foundations as well. Amy, how do you determine reasonable compensation when you don't know how much you'll earn in the year? Facts and circumstances. No, I'm just kidding. So some of the things you want to be thinking about is going to be where you're located, of course, how much money you're earning, because we talked about that, like what's reasonable kind of changes based on your income or your business profit. You want to think about like what somebody would be paid if they were in a similar role as you at market rate. Now, again, we have to stay reasonable. Maybe someone would be paid $150,000, but your business is only profiting 100. You're not going to pay yourself $150,000. But that is a factor as well, is how much they would be paid. And then there's some other things like how much kind of direct interaction you have with profit earning activities of the business. So if it's just you and you're like, I earn the profit through all the work I do, then you definitely have more like direct interaction with that. But sometimes when you have like silent partners in a multi-member LLC, that switches, right? Because you might have a partner that does nothing. And so what they're paid would be very different than somebody who's actually like generating the profit through their work. So those are some of the things you want to think about. We have a good YouTube video on this about how to set your, oh, Sarah's ahead of me. There's already an article in the chat. There's an article in the chat that goes into more of the specific details of the types of things to think about. And it really is going to be a mixture of everything. You're not going to like go down a checklist because some things might not apply to you, but you are trying to like find that sweet spot. All right, Helen, what type of retirement accounts can an S Corp contribute to? So we've already talked about this. The S Corp can contribute to the solo 401k. The owner of the S Corp can also contribute to IRAs and Roths and things like that, right? Because remember, who's making the contribution? Is it the business or is it you, the owner, the personal you? The personal you can contribute to like a Roth IRA, you can contribute to a SEP IRA, you can contribute to a solo 401k. But when we're talking about like the business itself making the contribution, so it's coming through the EIN of the business, not you, solo 401k. This is a good reminder. Like people often get this confused, but like you are a person too. So things like when you pay your taxes or you make retirement contributions, like sending $10,000 into your SEP, you may do that out of your business, but that's still coming from the personal use, not a business expense, unless it's something like a solo 401k where you're an employer making employer contribution. It's an employee benefit expense. Same thing with estimated taxes. That's a tax that you personally pay, not the business. Unless, of course, we're talking about your payroll and your salary. See, it all gets very complicated. Oh, I think I just closed somebody's. Let me go back down. Elena, do you work with partnerships? We do not work with partnerships or multi-member LLCs. Mona, what specific tax forms need to be completed every quarter for estimated taxes for the S Corp? Whew, I don't know if I can remember the name of the tax form. So there is a form that you, so a couple things. First of all, you can file your estimated taxes online, which is what most people tend to do. And in that case, you don't really need to like send in the form. You just file, you just go on to like IRS Direct Pay or EFTFS and you file your taxes through like the website and through the login page and things like that, which is really nice, frankly, because it's going to eliminate the need to like send in a form. You can just do it online. You can also set up auto payments as well through not Direct Pay, but the other one you can set up auto payments through, which is another nice thing. If you want to make a manual payment with a like check, there are little vouchers that tend to come with the that tend to come with your tax return. I can't remember the number on the voucher right now. I'm sorry, but there are little vouchers that you send in with your check. I would say at this point, most people are paying online, and that sort of eliminates this need to like submit a form because you just choose from a drop down what you're paying your, maybe it's 1040 ES. I think it's 1040 ES. You're paying that, and then that just, and you put in your social security number and of course all this other stuff, and then that is going to get applied to you because your social is attached. You will get a copy by default through it coming into your inbox. So watch out for your inbox tomorrow. We will send this to you. What is the tax strategy for filing taxes for properties held in the trust? We don't work with trusts. I don't have expertise in trusts. I'm sorry, Rocco, but I cannot answer any questions related to properties held in trust. That's a completely different type of tax expertise that I just don't have. Anonymous, if I live and work in different states, who do I pay quarterly taxes to? This is a great question. Well, it depends if you're earning income in both states and you are going to have to file income tax returns in both states, you will need to file quarterly taxes to both states. So I think it kind of comes back to, are you filing tax returns in both states? Then you need to follow the rules of each of those states around your income taxes. Federal is different, right? Federal is just the federal government, like regardless of where you are. So that's a little bit more straightforward. But I would kind of ask more questions around things like, okay, are you earning income both states where you're going to file multiple tax returns? Then you're going to have tax liability in both states, let's say. Then in that case, you would be wanting to file your quarterly taxes in each of them. Rocco, if your S Corp is owned by a foreign express trust, does that change how these taxes are filed? Again, we don't work with trusts. We really work with like small business owners. So this is really outside the expertise of myself and really like the scope of the webinar. Anonymous, if you file as an S Corp to pay yourself, do you have to hire a payroll service? You don't have to. You can DIY your payroll. Do you want to is a different question. I mean, payroll is very, very complicated, and calculating payroll is very complicated. It involves a lot of tax tables. It involves a fair amount of math. It involves having to ensure that you have withholdings put aside for different agencies and that you are sending to those agencies the right amounts, but also that you are filing the right payroll tax returns to the right places on an ongoing basis. So you certainly can DIY your payroll. There's no like law against that. You can, but the amount of math and keeping up with things that you have to do in order to really ensure that you're sending the right amounts in and the right returns in at the right time to the right people, it's quite a lot to keep up with. And frankly, payroll services these days, especially for like a single owner LLC with like an S Corp owner, so you have like one person on payroll, they can be extremely affordable. So it's really, to me, completely worth the cost of paying 45, 50 bucks a month to be able to just know that all of that's taken care of, because there's a lot of compliance stuff. And again, to manually calculate your own payroll and the right withholdings, you have to go look at tax tables, and that is not a lot of people's favorite thing. Burgencio, you only work with LLC tax as an S Corp, not full S Corp. So I don't know what quite you mean by full S Corp. I'm assuming you mean a corporation that has the S Corp tax status. And no, we do not work with a corporation with an S Corp tax status. However, an LLC filing with an S Corp tax election is also a full S Corp. The tax election is the same. Like if you, the way you're taxed, how the requirements of filing the business tax return, all of that, regardless if your foundation is an LLC or a corporation, it's the same. It's you're building the same house. You just have laid the foundation differently. So there's not really a full S Corp. But I think what you're asking is, if you're a corporation, if you already have the legal structure of a corporation, and then you have the S Corp tax election, if you can file, if we work with you and we don't. Jonathan, what is the best approach for dance services artists, and is it better to remain a sole prop or S Corp as an independent contractor? It really depends on how much money you're earning. It really just has to do with, are you earning enough where it's going to make a difference in your tax liability? Are you going to save money? It's sort of freeing and liberating in a way to really just think about it from like a numbers point of view and to be like, okay, am I earning $60,000 or more in profit? If the answer is yes, you want to consider an S Corp. If the answer is no, you may want to wait until you hit that threshold. It's kind of nice just to like let go into it being a really like numbers-based decision versus trying to weigh all these other pros and cons. I mean, I gave us some other pros and cons, but if you're looking for like a very simple way to be like, when should I start thinking about this? Is this the right time? Then just 60K in profit. Just that's the way to, that's kind of like that like North Star to be moving towards. I don't know what your profit situation is, but that would be like kind of my answer back is, it's not necessarily what's best for your industry. It's really like just stripping all of that away and thinking about how much profit you're earning. Liam, how does Collective handle businesses that close down? So we don't help with dissolution, but we certainly will help offboard you from our services. So if your business is closing down, there's going to be like an offboarding process. And, unfortunately, we do have this happen with some of our members. Just, things don't go their way, or they decide to take a W-2 job. They're like, I'm done being self-employed. That was fun. I want to go back to something else. We go through like an offboarding process with them, but we won't help with the actual like dissolution of the business. Okay. Anonymous. Is a business started as a sole proprietorship and is transitioning to an LLC? Some finances may not have been completely separated on the business credit card. How the personal and business bank accounts were kept separated? Should the business form the LLC in a different name to protect personal assets? So if a business started as sole prop and is transitioning to an LLC, some finances may not have been completely separated on the business credit card. However, their personal and business bank accounts were kept separate. Should the business form the LLC in a different name to protect personal assets? So I'm kind of having trouble understanding if you are an LLC that was messy and now you want to form a new LLC, or if you're a sole proprietorship and you're transitioning to an LLC. Here's the thing, you're going to have to start a new bank account. So let's pretend like you're a sole proprietorship and you're like, I'm starting an LLC, but my sole prop finances were a little bit messy on the credit card. You honestly are going to, when you form your LLC and you have an EIN number, you'll want to open a whole new bank account under the name of the LLC. That is where you're going to get that's going to reinforce your liability protection. So kind of whatever happened before that is just kind of what happened before that, but you would want to start anew with your LLC being like, I'm just going to make up a name, Taxes Are Fun LLC. You want a bank account that is for Taxes Are Fun LLC under that EIN number, because that really establishes that the LLC is a completely separate entity for yourself. So you need to start a new bank account for that LLC. Same with credit card. LLCs and like corporations can build business credit. They can have their own credit that is separate from the owner's credit. So the same idea. It's like you'd want to open a credit card under Taxes Are Fun LLC, not Andi Smiles, because you want to establish that it's a completely separate entity. Hope that helped. I hope that kind of answered the question. It's a little unclear. Nicole, do you have to pay estimated taxes if you're already paying taxes through monthly payroll? You do if the taxes you're paying through monthly payroll are not going to cover additional self-employed income. So if you're paying taxes through monthly payroll and you've added like additional withholdings and things like that, and you have done this in order to cover your future tax liability, then you don't need to pay estimated taxes. But if you're like, well, I have a W-2 job and I'm already paying my taxes through there, and then I have my self-employed, you're still going to be taxed on that self-employed income, and you need to be paying taxes on that in real time to some degree. So it kind of depends on, have you set up the additional W-2 withholdings and you're confident that that's going to cover what you're going to owe at the end of the year? Then no, because you've already are paying into that to some degree. You've already prepaid into that. But is this just a job that you have and it's really your W-2 withholdings are just based on the income you're earning at that job? Then yes, you still need to make those estimated tax payments. Okay. Can I get tax deduction for disability and life insurance if my S Corp pays for it? So I think you're thinking about this as like, if my S Corp provides a like an employee benefit, can I get like a tax deduction for it? Theoretically, yes, but there are a lot of rules around insurance. And if they're provided to employees who are more than 2% shareholders of S Corps, which you are going to be, if that is considered a tax deduction or a fringe benefit. So like, I would look into the rules around this, because it may not work the way you think it's going to work. I know I gave the retirement example, so your mind might be like, ooh, what else could I give myself and get a deduction? But the thing to keep in mind, you may be able to deduct it from the S Corp P&L, but it will show up on your W-2 as a fringe benefit addition to your income. So you basically didn't deduct anything. So just keep that in mind. You need to look into like the specifics of disability and life insurance for your state. But it's there are rules around what becomes like a fringe benefit and added to income if you are a 2% or more shareholder of your business, which you would be in this case. Brenda, do you work with people, companies who are operating by trust? We do not. That's why I've not been able to answer any of these trust questions. That is like a whole different part of like tax law. Then that's a different specialty than we or myself has. That's not we don't work with trusts. Thank you. I'm glad that you appreciated our time, Brigitte. Anonymous, estimated taxes for sole proprietors. How to estimate. I don't have payroll software. We've had this slide up. This is how you estimate. This is probably like the easiest way to go about it. It's here. You don't need payroll software to estimate your taxes. You either need to know how much you're going to earn this year or estimate that out and pay 90% of that, or you need to know what you paid last year and pay 100%. Alexandra, can you show the first S Corp slide that was in the beginning? Sure, I am happy to go back up if I can find it. I think you're talking about, maybe about this one, or maybe you're talking about this one. Anonymous, my business is a sole prop in Maryland and I have not reported sales yet. If I made a couple of sales in April and one sale in June, how do I calculate the fee and penalty? Frankly, remember, you only need to pay estimated taxes if you think you're going to owe more than $1,000 in annual taxes. If you've only earned $118, then you are very likely not going to owe $1,000 in taxes. So you don't need to worry about this quite yet. It's when you think you're going to owe more. So it's based on how much you've earned. So if at this point you're like, you know, and this is your sales. This is not actually like, are there expenses that you're writing off? You know, do you have $150 in expenses? Are you running a loss? So keep that in mind, is that you only need to pay your estimated taxes if you think you're going to owe more than $1,000 in total taxes at the end of the year. That said, estimating taxes and penalties are very, very difficult. We went through that. There's a lot of different things to keep in mind. So I wouldn't worry too much I wouldn't try to estimate it, is what I'm saying, because it is quite complicated. I think someone asked earlier, can I just catch up on my payments? That would be like my approach, is like trying to just get myself caught up. However, the amount of sales that you say that you've made, frankly, there's not enough here for you to even owe that 1,000. So you're good. Randy, can you show the dates the payments needed? Yes, I will go back to the payments. Okay, April 15th, June 16th, September 15th, and Jan 15th of the next year. Do your collective work with registered and/or trademark companies? And if it isn't, is under the S Corp. So we work with LLC. So if your LLC is registered and trademark, we should be able to work with you. But this is something I would talk to one of our tax advisors about, Brenda. I feel like these are like the very nuanced situations that I'm like, I don't have enough information. Who's registered? What's registered? What's trademarked here? So talk to one of our tax advisors. That person should be able to answer your questions and go through your personal situation. Anonymous, do you work with PLLCs with S Corp status? We do not work with PLLCs. And Alexandra, are you familiar with tax deductions for an at-home digital online business? I think maybe you're asking if like collective is, and we are. You know, we work specifically with solopreneurs, many of which are digital at-home businesses, because you know, a lot of online businesses exist these days. So yes, our team is familiar with, you know, how like the types of tax deductions and the types of things that we would see on your return. The other thing is that during Collective's onboarding process, you meet with an onboarding accountant to talk about your business and your types of deductions as they, you know, we get everything set up for you. So that's another place where we get more information about your business. So at this point, again, we've worked with thousands and thousands and thousands of solopreneurs. We're pretty familiar with the most common tax deductions for home and digital online businesses. All right, we went through all of the questions. Thank you all so much for sticking through the end. I'm always amazed at everyone, the number of people who stick around to the end of these things, because they are so, they get quite long, but I'm glad everybody was able to get their questions answered. Thank you all so much. And I hope that I will see some or all of you as collective members now or in the future. Thanks all.